Endogenous money is the theme of my next interview, and it's a pretty contentious fight in the economic blogosphere right now. On one side of the spat, you have mainstream economists who have, at times, argued that banks cannot, I repeat, cannot create money out of thin air. Now, they imply banks are constrained by their deposits and need your money first before loaning it to someone else. On the other hand, you have the heterodox economists arguing that banks do create money out of thin air because loans create deposits. They say banks make a loan to an individual without concern for reserve funding, and those individuals then deposit their money into other banks, increasing the broader money supply. Now, this is an econ boxing match headed to a whole new round. Now, today, I'm bringing you an important heterodox voice in this debate, Mr. Cullen Roche. Now, he's the founder of noted finance blog Pragmatic Capitalism, along with another blog called Monetary Realism, and I wanted to get his take on endogenous money, banking, and the European Central Bank. Take a look at what he had to say. Now, I want to give an example to our viewers of what we're talking about here. Now, the Bank of England, they came out with a video on money creation a couple months ago, and it's a breakdown of our collective understanding that bank loans create deposits, which in effect means that excess base money is not really inflationary, but of course, not everyone gets this. Now, for example, Nobel-winning economist Paul Krugman said in 2012, quote, "Any individual bank does, in fact, have to lend out the money it receives in deposits. Bank loan officers can't just issue checks out of thin air. Yet, now, Krugman has dismissed the BOE paper as nothing new. So what do you make of this dismissal?
Well, I think that there's some revisionist history going on with the way that some economists are viewing past statements. I mean, if you look back at the crisis period when, for instance, when the Fed was beginning quantitative easing, there were a number of people, Ben Bernanke, Alan Greenspan, Paul Krugman, Scott Sumner, a number of people who came out and said that there was this huge future inflation risk because the central bank had flooded the banking system with all these reserves. And the concept was that these reserves were somehow going to get out, that this was money that was just, it was being held onto for now, and that it was somehow going to be lent out, or it was going to get out into the banking system and cause a big spending panic and hyperinflation or something. And, you know, of course, that never transpired. And the reason why was because that's just not the way that it actually, that's not the operational reality of the way that banking works. And so, yeah, I mean, I think that it's worrisome to some degree that I think that when we look at the financial system and the monetary system, it's worrisome how some economists, they treat banks as pure intermediaries in the system rather than as these very important actual money creators.
Now, recently, FT columnist Martin Wolf pointed to the Bank of England video saying deposits that banks created as a byproduct of lending made up 97% of the UK money supply. But he's really not comfortable with this. He says that we should strip private banks of their power to create money and leave that in the hands of the state. Now, what do you think of Wolf's view?
Well, so Wolf kind of goes on the opposite end of the spectrum. Instead of viewing the central bank as the entity that creates all the money, he views the banking system as sort of I think, the entity that creates all of the money. And while that's, I think, a truer story, I think that there is I think, a little bit of maybe fear-mongering over the idea of banks in general. If you look at the actual business of what is really old school banking, sort of the 3-6-3 model, which is you borrow at 3, you lend at 6, and you're on the golf course by 3. It's actually a very boring business model. It's a very benign operation that, if done prudently and properly, it's not a huge profit maker for banks. And so I think that there's some tendency sometimes in the modern economy to take what is really the more speculative arm of banking, which is, sort of the hedge fund side and a lot of the things that we saw during the financial crisis that got the big banks in trouble, and to intermingle that with the much more benign and commercial banking side. And what you get is, I think, this sort of view in general where people demonize banks, I think unjustly to some degree. And I think that ends up, feeding into this idea that we need to sort of, strip the banks of all of their powers and maybe nationalize them. And I'm skeptical of some of this thinking because I think that at its heart, the loan creation process is really that the banks are acting in a relatively benign manner, in that they're really just providing a service by providing credit for people, people who buy homes, people who are using credit cards, people who are starting businesses. They're just acting in an intermediary sense there, in that they're just providing the credit. So I think that on the whole, I'm skeptical of the idea of nationalizing that operation, just because I don't know if a government can run the risk management arm of a lending side of a bank any better than, private bankers can.
Now, Cullen, as we all know, the U.S. employed QE, creating trillions of dollars of excess reserves, and some think this was a pretty good policy. And now the ECB is considering quantitative easing. So do you think that they will start QE?
I think that there is a high probability that they're going to, because I actually posted something today on my website showing the spread between the government yields in some of the peripheral countries and the private securities markets. And what we're seeing is the sovereign yields are coming way down. So we're actually seeing record lows in the yields, and for instance in Italy and Spain and some of these countries, which is sort of its own frightening development, because we're sort of back to where we got to with all the the funding and borrowing that caused the crisis to a large degree in the first place. But the more interesting thing is that actually the private securities markets have not followed the same path. So what we're not seeing is, we're not seeing a big, say, investment boom in a lot of private corporations in Europe, because we haven't seen the yields on private securities drop to the same degree that they have in the government market. So yeah, I think that the ECB is probably troubled by that to some degree. They were probably hoping that they would see private securities markets yields decline along with government yields, and they haven't seen that. So I think there's an increasing likelihood that we could see the ECB come in and implement some sort of quantitative easing program that actually intervenes directly in the private markets, and probably in addition to intervening directly in the government markets as well.
If the ECB buys government bonds, won't that be a case of monetizing debt and financing deficits, which is against Article 123?
Yeah, well, I mean, I think we're walking a very fine line here with what the ECB is doing. In a lot of ways, they've already implemented sort of a backdoor bailout of a lot of these sovereigns through just the way that they're backstopping the purchases of bonds at present. So, we've already seen the ECB, I think, kind of step over this line to some degree. And, I think that the leaders in Europe are realizing with increasing urgency that it really is necessary for the ECB to be more interventionist in their economies until you see something that is really a long-term fix in Europe, because ultimately that's the direction we're headed in. Europe is, without getting too complex here, Europe is a lot like the United States in that they have a single currency. They have a bunch of different countries which are all users of that currency, but none of them are issuers of the currency. So you don't see, a sovereign or state debt crisis in the United States, in large part because you have this big redistributive system that helps alleviate a lot of the debt pressures over time. And you don't have that in Europe. And until you have something that looks like that, or you completely unwind it and go back to having them all be sovereign currency issuers, this problem is going to remain, and you need an entity like the ECB, or either a treasury type entity, or euro bonds or something like that, a supranational bond that can alleviate some of these funding problems at the state or the the national level. And so yeah, I think that